Thanks for clicking. My name is Mark Mitchell. I'm a mortgage broker here in London, Ontario. Some concerning inflation data came out today. This was just a few minutes ago, actually, from Statistics Canada, showing that our inflation rate had risen to 4.1%, which is up from the previous rise of 3.7% released last month. Ideally, the Bank of Canada shoots for a between 1 to 3% inflation rate before they raise interest rates. So this is definitely a little bit concerning going forward. So in this video, I just want to briefly go over the rise in inflation, what's causing the rise in inflation, what this means for interest rates, and what to look for next when you're planning your own economic activity. We will have some more updates out tomorrow as the Canadian Real Estate Association is set to release its housing data today, and CMHC will be releasing its own data tomorrow. So click subscribe to get those updates, but for now, let's get into the inflation data. So as we said, inflation rose to 4.1%, up from the previous level of 3.7%. Which was kind of expected. In fact, the Bank of Canada has said before that it actually, despite its mandate, wants to see inflation go a little bit higher than it had before. We've done a few videos on this, although its mandate is to see inflation go between 1 and 3%. The bank does want to see it run hot as they are hoping to overshoot in order to help get full employment. We did see a few weeks ago that GDP data that our GDP had shrunk, which is really what you don't want to see, especially with rising inflation, as it can lead to stagflation. But we're still waiting for more GDP data to come out to see whether or not we are looking at stagflation. But the 4.1% increase is what the Bank of Canada says they were looking for, as it's thought that this will help lead to full employment and more GDP growth. So that's yet to be seen, but it's still important to remember to take a look into what exactly is causing this rise in inflation. The main culprit listed on StatsCan is a rise in gasoline prices. I think everyone's probably seen at the pumps that prices are starting to really rise quite quickly. And Stats Canada notes that we've seen a 32.5% increase in the price of gas since last August. So obviously, as the price of gas goes up, anything that needs to be transported, those prices are going to go up as well. Secondly, the prices of housing starts has gone up as well, over 14% since last year. This is noted in the Consumer Price Index as the Homeowners replacement cost, but it's directly related to the price of real estate. So, I mean, again, I don't think this will come as a surprise to anybody, but real estate prices have gone up. And we've noted this on this channel almost every single video. Also noted by StatsCan is the price of real estate fees. Obviously, if prices of real estate goes up, the price of real estate fees and commissions are going to go up as well. Don't shoot the messenger. I do mortgages, and 99% of the time there are no fees, so it's not my fault. So what's this mean for interest rates? Well, in normal times, we would expect interest rates to go up as soon as inflation went up. The last time that inflation was this high was March of 2003, at which time interest rates, or the prime rate, was 4.75. Compare that to now when the prime rate is still 2.45. As any homeowner, as any person that plays variable interest rates will tell you, a rise in 2.5 interest rates is huge. That's massive. So we don't see any corresponding indication from the Bank of Canada that they will be raising interest rates. So that should give you an idea of what a different point in time that we are in right now vis-a-vis interest rates and our inflation data. As mentioned, the Bank of Canada has said that they're going to let inflation run hot. They're going to let it run for 5% even before they consider raising interest rates, as they look to see that employment data shoot back up. They are probably even more concerned, I would assume, based off the release of the weak GDP data, that our economy is going to need even more support. So look for the Bank of Canada to continue to let inflation run even hotter without raising rates, just because of that weak GDP data. That leads us to what to look for next. You really want to look at the GDP data that's set to come out in the next few weeks. That data will let us know whether or not we are actually looking into a period of stagflation, which is high inflation and low growth, which is really what you don't want to see, and was largely the cause of the high interest rates in the late 70s and early 80s. So Obviously, things are getting more expensive, and I think that bears that out, and that is bared out in the data, and we see it every day. We see it at the pumps, and we obviously see it in real estate, and I certainly see it every day in my business, in my job. So, no surprise to anybody that prices are going up, but really, in order to see what's going to happen with the interest rates, we're going to want to keep a close eye on what happens with that GDP, which, like I said, should be released in the next few weeks. If you like this video and you want to get updates when that GDP data does come out, click that like button and subscribe, and we'll have more updates as they're released, including those updates coming from the Canadian Real Estate Association, which are supposed to be out today, and CMHC tomorrow. Thanks for clicking. Bye.